Hello everybody, so welcome to this Black Friday deals video where I specifically want to talk about 3 different stocks, HIMS, Oddity and Nebius. I haven't talked about these stocks in a while. Of course it is Saturday, but that's a video I was planning to make yesterday, couldn't quite make it. So anyways, HIMS, let's talk about HIMS. HIMS rebounded quite a bit. We're up 18% from the November 20th low. Note that most stocks and so many assets really made a low around that same time, right? It's risk-off environment. A lot of these stocks have been sold off because of a risk-off environment that we're in. I cannot still to this day possibly explain how HIMS is trading at $39. It makes absolutely no sense to me. Note that the company agrees with me that it makes absolutely no sense because they've just authorized a 250 million share repurchase program, and I sure hope that they are buying back some shares. HIMS is a stock that has been a roller coaster. It's been unfairly punished through series of FUD for the history of the stock. First being dismissed as just an ED pill company. Second being dismissed as, oh, if they stop the marketing spend, the business is going to fail. Third being dismissed as just a GLP-1 company. And they keep being dismissed by a new narrative every 6 months, roughly. But at the end of the day, what matters is the revenue growth. And the revenue growth at HIMS is absolutely outstanding. I've said that multiple times in my prior videos. Q3, most people, including me, were expecting Q2 to Q3 to be flat. Q2 to Q3 was not only up, but it expected Q1. The reason why Q2 was so bad is because Novo Nordisk ended their GLP-1 partnership, which led to a bunch of cancellations, a bunch of wasted marketing, and we thought they would need multiple quarters to recover. Turns out they didn't. Turns out they recovered right away. It was just a single quarter issue. And if you look at the number of subscribers, they've been growing steadily, 21% year-over-year growth. The delta between 21% and 49% means that their subscribers are buying more and more products on the platform. They're growing both in subscriber count and in revenue count. 2.5 million customers are on the platform. This facilitates cross-selling of a whole bunch of different medication, different drugs that these customers may be available. This also facilitates AI learning. You learn which medication worked best on some customers, and then you have AI recommendations that are given to their now more than 2,000 providers. They have more than 2,000 providers, i.e. doctors and nurse practitioners on the platform who prescribe for the 2.5 million customers, and these prescriptions are AI enhanced. AI is helping prescribers make the prescription, and of course, in a few years, it's very likely that we will just have AI take care of our health. And when AI takes care of our health and the law evolves and you eventually remove the doctor from the equation, the margin is going to go through the roof even more. Note that they've been doing a good job at reducing their operating expenses from 67% of total revenue to 65%. Marketing spend. Everybody was so worried about marketing spend going through the roof and being a problem. It went from 45% to 38%. As a result of that, adjusted EBITDA has been bouncing. It's a little low in Q3 and in Q2, but that's because they've invested a tremendous amount in CapEx, in different aspects of a business, buying Zava in Europe for European expansion, building a third facility for peptides and shipments, building a new product offering. They've had a new product offering for menopause, testosterone, recently labs. They just launched labs. This is a company, in my view, that's just firing on all cylinders. And as a reminder, the grand vision of HIMS is a digital pharmacy. We don't need 45,000 physical brick-and-mortar pharmacies anymore. We can have it all done digitally. So it's first and foremost a digital pharmacy with a digital doctor. The doctor is bundled within the cost of the drug. Most doctors treat patients for small to medium issues by prescribing drugs. So HIMS innovated by including the cost of a doctor into the cost of the drug. Innovated the business model. If the doctor can't prescribe you something, you don't pay. You only pay if you get the prescription that you need. You only pay if the doctor can treat you. This is a disruption of a traditional health system where you pay to see the doctor and the doctor may not be able to treat you. The doctor may start what I call a ping pong loop where the doctor refers you to another doctor who may, in some cases, refer you to a third doctor. And each time it's between $200 and $500 each time. HIMS entirely eliminates that. HIMS is a 0-to-1 business. They eliminate all of these costs. And lastly, the last innovation of HIMS is the minus insurance. They don't accept insurance. Because they don't accept insurance, they can save on administrative costs like crazy, period. They save on administrative costs. And more importantly, they go fast. They can move very, very fast because they don't need to set up a payer infrastructure in the back end. They don't need to spend a lot of resources to just go collect reimbursement from insurance companies. And as a result of that, they can move so much faster than the other players in the space. This company is a 0-to-1 company. Most people don't understand it. This company, I firmly believe at this point, is also going the way of a big tech company with a single brand trying to take over healthcare. Most people also do not see that just yet, but I think they will. Eventually they will. And if you look at the valuation of HIMS, we have been stuck, between 0.1 and 0.15 for now a year and a half. We had a period of hope where the stock had actually reached like a 0.2 on enterprise value over gross profit or revenue growth. But we've come back down. We've come way back down. This stock is way too cheap. It's way too cheap if you look at traditional metrics like price to EBITDA or price to gross profit or price to revenue. It's very cheap, but it is also cheap if you look at my growth adjusted metric, which is enterprise value over gross profit over revenue growth. Rule of 40 is a 60 for HIMS. So that's also outstanding. Looks much more like a SaaS company, and that's the last point of him. Much of it, more than 90% of our revenue, is recurring revenue. Oh, and the drugs are custom, so the product is sticky because the drugs are customized to the patient. That's another thing that's enabled by tech and AI, is you can customize the drug to exactly what the patient needs. So to me, this company is highly disruptive. Most people haven't caught on, and the fact that we're down rough, not quite, maybe 45, but from the highs, from the last highs, we're down nearly 50%. So even though we bounce back by 18%, to me this is still an insane steal. HIMS is a steal to me these days. Still. So anyways, talking about another company, which I find better than ELF. I spent a little bit of time this morning looking at ELF, and I still don't find ELF attractive. I think ELF, the fact that they're so impacted by tariffs, they make their products in China. Oddity, from what I understand, makes their products in Europe and especially a lot in Italy. That's what I kind of understand with Oddity. It's a 15% tariff versus a much higher, right? 55% or something tariff in the case of ELF. And it doesn't grow as fast, and the margin isn't as good, and they have to share the margins with, retailers in the real world, like the Ultas, the Walmarts, and especially Target, right? ELF shares margin with Target. Went to Target yesterday, it was empty. Target's empty. So I don't like ELF nearly as much. I love Oddity. Oddity is only direct to consumer. They only sell online. They control their entire channel. They only sell online. And Oddity is a beauty company, of course. It started out as a makeup company. It's an appearance company. I guess I will call it an appearance company. It's transforming beauty and wellness through technology. They use technology to create sticky products that women love and keep going back to. Of course, their first product was Il Maquillage, which kind of works like HIMS. So what happens is you answer a questionnaire, you take pictures, you scan your face, and the foundation, which is the color of the makeup, will be exactly the same color as your skin. It solves a challenge in makeup, which usually is solved by letters and colors and contrasting. And so Il Maquillage makes a custom color just for your skin. And of course, there's millions of shades. And they were able to crack one woman, one shade. They were able to crack this because of AI. And that's why the product is highly recurring sales, because women come back and buy the product again because it's exactly their tone, their skin tone. Fascinating product, how they use data to create a better makeup, right? Spoiled Child is a similar product, but it's for anti-aging, it's for collagen solutions, and they're custom AI solutions to make your scalp better, to make your skin better. Liquid collagen, peptide mixes, different mixes of peptides that you can spray on your head to regrow your hair or whatever. Customized, of course, in anti-aging, customized to each woman's hair, each woman's complexion. So that's a similar business, and same. It's formulated by AI. It's AI who decides. So you don't get to pick between a product or not. No, the product is custom made for you, and that's on its way to being $1 billion brand. Both of these brands are on their way of being $1 billion brand, and they just launched a third brand with the same concept. This time is an online dermatologist. They do prescription dermatology creams, but of course, and it's called Methodic. But of course, it's powered by AI, and this is a product they just launched a few weeks ago. And this is quite amazing. You can scan your face, so just like they do for the makeup, you scan your face with your little phone, and then it tells you what you got: lesions, whiteheads, scars. It's able to detect eczema. It's essentially keep in mind, on an iPhone now, a camera is something like 50 megapixels, right? So it's able to detect so much, and then with the use of AI, it's able to formalize a special cream that is just for you. But by the way, the HERS app, HIMS and HERS, they need to do that too, right? And my guess is that we will do that more and more. I also fundamentally believe that cameras are going to get so good. I've seen a lot of prototypes, coming out from different companies. Are we going to have things like X-ray within a phone, or something like an X-ray within a phone at some point? Possibly, right? Or an ecography type tool. That's also going to tremendously help prescription if we have professional eyes within our phone, professional laser instruments within our phone that allow us to scan whatever we got on our body that's wrong, and then you use the AI to make the prescription. And of course, these companies, whether it's HIMS or Odd, they're applying this to the real world. And of course, Odd is applying this to beauty. HIMS is applying this to health, but there's kind of a confluence of the two in the world of dermatology. In fact, dermatologists make most of their money on beauty. That's where they make most of the money on. So, anyways, Oddity stock, Odd stock, enterprise value over gross profit over revenue growth is 0.14. It's dirt cheap. You can see the similarities with HIMS. It's just as cheap as HIMS. Rule of 40 is almost like HIMS, and the stock. The similarities are uncanny. The stock is also down 50% from roughly its later highs. It's crazy. This market does just trades all these stocks in baskets, and it's up 18% since the low. HIMS is also up 18%, 18.26, 18.26. Well, I didn't do that on purpose too. They're both up 18.26 from their lows. What a coincidence. I totally didn't do that on purpose. I just noticed now, 18.26. That's pretty crazy, if you ask me. So the market is trading these stocks like basket and not looking under the hood, the power of these companies and the disruption of these companies. The dermatology is huge. What if Oddity took a bunch of business from dermatology? And keep in mind, these companies, whether it is HIMS or whether it is Oddity, they are highly social media native. They're connected to all of these social media influencers. They send free products. It's a lot of these sales are very much Instagram driven, right? In the woman world, a lot of the sales are Instagram driven, and they're all over Instagram, right? Same for HERS app. So it's pretty crazy. The HIMS app is more something like college football and that type of stuff, and YouTube. But the HERS app is all over Instagram, and TV shows, etc. So it's just we're so much better at marketing than your local dermatology office. It's not even funny. We're not even the same link. So they're going to take over a lot of business, in my view. Lastly, let's talk about Nebius. Entirely different world, although you will note that AI is a common thread. All of these kind of are powered by AI. Well, those two are Nebius, HIMS and Odd are powered by AI. Nebius is the AI on the back end. So Nebius is the AI company that the market loved a few months ago, and now the market for some reason doesn't love it anymore. The market has a memory span of 10 days or something. This is kind of ridiculous. You may remember the stock popping overnight. It was right here. It popped something like 30% in a day when they announced a Microsoft $19.4 billion deal. And they also got a $3 billion deal from Meta, which they announced with their Q3. Nobody noticed. No, nobody discussed it. Nobody noticed, right? Any other company announces a Meta $3 billion deal, the stock would pop 30%. Nebius, nobody noticed, right? The market is crazy short term. You're looking at a company whose forward revenue growth, and I'm using that number, I'm using their 7 to 9 billion run rate that they plan for 2026. So they're going to grow 16 times their revenue over the next 12 months. 1,600% growth over the next 12 months. They're going to move from 500 million to, let's call it 8 billion. So that's absolutely insane. That's actually the analyst number, because that would be even higher, right? But we don't know. But they're going to grow more than 1,000%. They're going to grow anywhere between 1,000 and 2,000%, maybe more if they get another deal. And so that means that EV over GP over RG is ridiculously cheap at 0.04. It means that the rule of 40 makes no sense, because when a company can do a 20x in revenue in a year, the growth adjusted numbers start making no sense. And even if you look at this company like on a forward revenue basis, it's 2.5. On a forward gross profit basis, it's 4.5. So it makes absolutely no sense, the value of this company, if you ask me. The market is driven, it's so narrative driven. Keep in mind, this company is entirely sold out. They sold out all of their capacity. They're looking for new power to grow even more. They have 4.3 billion of spending that's covering a lot of the capex that they're going to have to buy these GPUs. And for some reason, the market has been worried about how they finance the GPUs. And the market has sold off the stock, actually, depending on how you look, between minus 30 and minus 40. At one time, we were down 40% from early October optimism. This stock was trading at 135, just 40 days ago. Now it's down to 95. And it was even below that. It traded down to the low 80s, as if the market had forgotten that they have nearly 24 billion. They have 23 billion coming their way, and that's just from two hyperscalers. They have leading customers like Cursor AI also uses their product, which is one of the leading quote unquote vibe coding apps. So pretty crazy if you ask me. The stock is so cheap. And, I guess the market right now, the narrative is, we are fearful about how we're going to finance the build-out, how we're going to finance the GPUs. But as the CEO said in the investor letter, they can attract secure, like asset-backed debt, and this is how other stocks have grown, like CoreWeave, for example. Is you can acquire other GPUs, and you can pledge those GPUs as collateral to borrow the money. So that's the way they're going to grow, and capital is going to get cheaper and cheaper. And of course, when you have hyperscalers as your customers, when you have Microsoft and Meta as your customers, it's much easier to get financing. They also have an ATM in place, but I don't think they're going to use that much. They just have it in place, and we don't know if we get into a bubble of AI, like a bubbly share of AI. If the stock gets a little bubbly, it may make sense to use the ATM. But we are nowhere at these levels. But if the stock was to pop to 300, it would be beneficial for the individual investor if they did an ATM. You may remember Tesla in the early days took advantage of great price when they issued some shares back in late 2020. NVIDIA, a few years ago, the stock had popped a lot. They benefited from doing an equity offering as well. So that's okay with me if the stock has been overbought and there's a clear bounce that's going to draw back down, right? It's you do buyback when the stock is cheap, but when the stock is super expensive, you can issue new shares. So I'm not worried about them financing at all. The market is worried about that. And the market forgets AV Ride. They're going to deploy their first autonomous ride share service in Dallas pretty soon. I personally think Tesla is going to win that market, but there's people who don't believe that. And so in that case, you have to value that within Nebius, because Nebius owns AV Ride. And so what's the value of a standalone self-driving company that tries to compete with Waymo and Tesla? What's the value of that, right? Some people could attach like $1 billion valuation to that or something like that. And they have very interesting like food delivery systems. But of course, the most important is their 28% equity stake in ClickHouse. ClickHouse is I would argue it's a competitor to Snowflake. And it's a competitor to Databricks. So they're right there. They're right there. And these startups are stakes that they owned from Yandex, right? From the Yandex days. And of course, the last point. The management team is the former management team at Yandex, the Google of Russia. So they come with relationship and you come with an experienced manager. So this stock has everything to please me. And of course, the valuation is so juicy at a 0.048. And it is cheap. So Black Friday deals, they're all between 40, 30, and 30% down. So 30%, 30%, 40% down. So this is even better than a Black Friday deal, if you ask me. And I guess it will be a Cyber Monday deal if you like these. I like these stocks a lot. I like these three a lot. So anyways, this was not investment advice. This is not financial advice ever on this channel. This is only entertainment. I'm hoping you were entertained. Please like, please subscribe. Follow me on Patreon. Follow me on X. Thank you for watching and have a wonderful, wonderful day.